Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, permanent life insurance, part 3 in our series on protecting breadwinners, partners, and key employees. Well, welcome everyone to our third segment. Now we're talking about permanent insurance. And when I'm looking at permanent insurance, it has cash value. And the first permanent insurance that has cash value that I want to address is the traditional and long-standing participating whole life. And remember, many carriers used to be into this game. It's a lot less now, but the people that are in it, some of the top 5 carriers, have some actually decent returns. Shockingly, some people use participating whole life as an income vehicle or a bond alternative, not for indemnification, although it has a death benefit. So sometimes when people are looking at cash values, they're also looking at a participating whole life because it's a disciplined monthly, they're paying their premium monthly. It's a disciplined monthly dollar cost averaging into an insurance policy. People like it because it comes out, it saves money automatic. Most people say, I like that. And remember, taxes, that has a tax advantage. It accumulates tax deferred. And if you take out strategic withdrawals of basis, your original contributions, and you take policy loans of gain, and you keep that policy in force for the life of the policy insured, you're going to take that money out tax-free. And keep in mind, at retirement, at least under current law, we don't have to pay, that is not included in the provisional income test for Social Security, so you don't have to worry about paying extra taxes on it because that income is actually free. So when I'm looking at permanent whole life, I'm looking at permanent whole life for two reasons. One is my basic coverage, my indemnification. I'm trying to protect myself, cover my family, but cover my business partners, cover maybe even key employees. Think about that. There are people in businesses that are really key. You might have a rainmaker that works for you in your small business. And without that person, you wouldn't get this kind of revenue that comes into the shop every day. So you want to be able to cover that key person. If that person died, you'd really feel the loss again of that revenue, his ability to generate her ability to generate income for the firm. Keep in mind, that is insurable interest. That's insurable justification. So I have a reason for that because I'd be exposed to liability and I'd be hurting economically if I lost my employee. Think about this, business partners. We own things together and we may want to be able to do a buyout. It could be a buyout, it could be a cross purchase, it could be stock redemption, it could be wait and see trust. It just depends upon your need and how many partners you have. And you may want to be able to own cash value contracts on each other to indemnify each other, as well as have accumulating cash values as part of your retirement strategy in your business plan. So for basic everyday people, everyday Americans, sometimes you just need to have a track to run on, a basic savings plan. This could be the way to go. Some of these contracts over the years have been paying between 5 and 5.5% in total accumulated dividends. Now, the dividends aren't guaranteed, but remember, when you're talking about whole life, the actual premium for death benefits you're buying is guaranteed for life. They cannot change it. You have to remember, when is this contract coming due? So the endowment date or the date that it matures could be, depending upon what you call it, it could be age 100. I've seen contracts out to age 121 years. Think about it, 120 years. You say, Steve, that's absurd. Yeah, but think about it. Jean Clement died at 122 years, 164 days. So it's not out of the box. And yes, Jean's an outlier in the death benefit scenario there. But think about it, death benefit all the way out to 120. And some contracts, not all, once you get to age 100, they just cover you for the next 20 years. You don't even have to pay premium. So just keep in mind, participating whole life is an idea. It's an example, and that's one area that you should look at. Permanent insurance, guaranteed. The dividends aren't guaranteed, but most of these companies have been paying decent dividends on a regular basis. Very few have missed their dividend. They've missed their dividend projections, but still not missed paying dividends. But remember, it's not guaranteed, so this will all change. And I can't use history as a future predictability of how they're going to go. But so far, I feel pretty comfortable, especially when they're highly rated carriers. When you have S&P, Moody's, AM Best, some of the watchdog industry that look at their financials, they have claims paying ability and financial stability. That's okay. Now, I want to look a little bit at universal life just for a second. I mean, I talked about in the first segment, you could buy guaranteed universal life, GUL as they're called, and guarantee the premium, guarantee the death benefit. It's not going to have hardly any cash. It's kind of like an extended term contract. So you have to look at what you're getting. You have to make sure you're making your payments on time. And if you do that, you can start looking at what death benefit time you want it to terminate. So at age 100, or at age 105, or at age all the way out to 120, depending upon what you think your needs are. If I had serious longevity in my family, and I already see medical technology going to take us to further frontiers in human longevity, I might be looking at 120. Now, universal life has guaranteed universal life, like I just spoke, but it also has interest-bearing universal life. Right now, it's kind of fallen out of favor in a low interest rate market like this. Not many people are using universal life for saving vehicle, and they're not using it for a death benefit vehicle. So even though it's still there, and it's the father, the grandfather of all the other universal lives, guaranteed universal life, index universal life, and variable universal life, even though it was the forerunner to all that, right now, in and of itself, it's kind of fallen out of favor right now. Now, I'm going to look at index universal life as a possibility. Index universal life is tied to an indice. It could be foreign. It could be domestic. It has different crediting ability from that indice. So let's just pick the S&P 500 since everybody understands that. So if I wanted to buy the S&P 500 in an indexed universal life contract, I am not going to participate in the dividends. So if you say, Steve, I love the S&P 500. It's part of my portfolio. And in my portfolio, I actually get the dividends. But keep in mind that index universal life, even though I don't get dividends, it has a hedge position or a market bottom. I can't go below zero. So even if the market went down like it did in 2008, my crediting amount wouldn't go down. So it'd be zero. It wouldn't be negative 10, negative 12. It would just be zero. Some people say that's a pretty good trade-off. I don't get dividend participation, but I also don't lose when the market goes south. I can't go below zero in that crediting year. Keep in mind that there are policy costs. So even if you got a zero credit in that year, you still have to pay certain costs like cost of insurance, and those are deducted off your account. So technically, you could experience a negative year in an index universal life contract. Now, some people have long haul mentality. Some people love mutual funds and ETFs. So they'll be more inclined to look at variable universal life because they're already conditioned in their 401k participation and their other separate venture investing. But keep in mind, and it's really a big issue here, is you have to always do a risk tolerance test for an item like this because it has risk to it. You could lose your money. And think about it. If you have to have the kind of psychonomics, the kind of profile, financial profile that can support buying a security like this. So long term, remember, it accumulates tax deferred just like all these do, and they also can come out tax-free withdrawals to basis and policy loans to gain as long as it's held in force for the life of the policy insured. And by the way, just heads up, notice I said the life of the policy insured, not the policy owner, not the policy payor, not the policy beneficiary. Whoever the insurance is on, that policy has to be kept in force so that I can take out withdrawals to basis tax-free and policy loans tax-free. That's the basis of it. One other thought, in 1988, we had to change over the law. It's been a long time now. We call it TAMRA compliant. It also, to be tax-free, it has to comply with the TAMRA regulations. I won't get into that today, but just remember, when you're looking at your policy, your illustrations, your proposals, it'll tell you if it's a non-modified endowment contract. That's what you want if cash value is important to you. So remember, you could do participating whole life. You could do guaranteed universal life. You could do interest rate universal life, indexed universal life, and variable. There's 5 different permanent chassis that you can choose from. If you think cash means anything, then you should look only at variable, indexing, and participating whole life. GUL is not going to have any cash, and right now the interest rates are so low, and I don't see them going up too far anytime soon. So UL itself, universal life, is probably not a play. Look at these permanent policies, and especially if you have permanent ongoing scenarios. For example, some people like myself not only had our children in our 20s and 30s, but we had some children later on in our life. So we had to extend our coverage to cover those kids when they were still with us. And I also had obligations that I wanted to have a cash value contract during my retirement years, because remember, in my retirement years, I don't want to always have taxable qualified money. There's no basis in it. It's all taxable. It's all included in my Social Security provisional income test. Sometimes I like to have other monies that aren't really calculated not only for my Social Security tax, but for my normal ordinary income tax. So sometimes when you're looking at permanent life insurance, it can be a great retirement supplement while you're still covering yourself in case something happens. Don't forget to watch our next segment on how much life insurance, part 4 in our series on protecting breadwinners, partners, and key employees. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, and financial advisor. You've been watching Steve Savant's Money, the name of the game.